It's a double blow for the economy yet again, with the retail inflation rising at an 8-month high of 7.34% in September and the industrial production contracting by 8% in the month of August. Let's do a 3-point analysis to find out when the economy is likely to recover from this grim situation. 1. Reasons behind the spike in retail inflation. Well, consumer price index-based inflation for the month of September came in at 7.34% from 6.69% back in August on the account of rising food prices. Now, this marks the highest level recorded in last 8 months, also well above the RBI's target range of 2 to 6%. Now, food inflation also rose to double-digit levels and came in at 10.68% this time. This is just days after the Reserve Bank of India predicted gradual easing of the retail inflation. Also, the RBI in its monetary policy statement last week had said that the prices of key vegetables like tomatoes, onions and potatoes should actually ebb by October to December with the Kharif arrivals as well, even though the prices of pulses as well as oilseeds are likely to remain quite firm due to elevated import duties. The RBI also has projected the CPI inflation to average at 5.4% during October to December and 4.5% during January to March. 2. IIP contracts for the 6th straight month. Factory output has continued to decline for 6 consecutive months in August as well, recording an 8% contraction this time, and that is mainly due to the degrowth in manufacturing, the capital goods and the consumer durables output as well. But it has definitely shown a sequential improvement from the 10.8% contraction that was seen in the month of July. Now, manufacturing sector, which actually contributes or has a weightage of 77.6% in IIP, contracted 8.6% in August. Consumer durables and consumer non-durables output indicators for consumption demand actually contracted 10.3% and 3.3% respectively in the month of August. Now, output of capital goods has contracted 15.4% during the month of August as well. IIP as a whole has contracted by 25% during April to August period as against a growth of 2.4% in the same period last year. 3. When will the economy recover really? Well, the macro picture with the latest numbers does raise questions on the recent optimism around the economic recovery with the phased unlock phases. Now, it will also make it more difficult for the RBI to boost the economy via the monetary policy route until inflation really cools off between its target range. Also, August IIP number belies the optimism generated by PMI for manufacturing, which was above 50 in August. Now, a PMI value above 50 definitely signifies expansion in economic activity. The recessionary grip is actually spread across the industrial sectors in terms of economic activities. Now, RBI's MPC last week had described the recent rise in inflation as a transitory phenomenon as well. But going forward, it expects the inflation also to ease with the unlocking of the economy. Most experts with the latest inflation numbers believe the RBI will not cut rates till inflation really cools off to RBI's target band. A sharp rise in food prices at the time when employment and wages are under a squeeze definitely means that households will also find it quite difficult to spend on non-food items, which will generate headwinds for the aggregate demand. Now, core inflation has been quite flat and suggests that the non-food economy might not be facing much of a supply side problem. Now, experts also say that this is stagflation, that is negative growth coupled with the high inflation that will impact the middle class as well as the taxpayers as well, and thus demand generation will be a big challenge going forward.